Welcome back to CEO Money. I'm Michael Yorba. Thanks for joining us. All right, I've got Michael Markowski on the show with me right now. We just had all of our tariffs put in place at midnight last night against China. China is pushing back with their tariffs on our stuff. But Michael, I'm looking at the market, and S&Ps are up, bonds are not, they're not crashing. Doesn't look like the traders, the institutional or retail, are seeing this as a big mover and in any direction. Shed some light on this for us.
Well, first of all, Michael, the traders are in the market. This market right now is by all the statistics that I've been looking at is fully dominated by traders. Long-term investors have left the market. The S&P turnover of S&P shares, I put an article out about this yesterday, has now at the level of it's exceeded 2.9 trillion per quarter, which the last time it hit this level was the first half of 2008. So what's happening is all the long-term investors are getting out of the market, and long-term investors don't get back in the market after they've taken a capital gain unless either a recession has begun and prices have come down, or prices come down. So what happens is now all you have is short-term traders relying on short-term traders to buy their shares. So right now the market's acting more technically. It's not acting on the news, but it will act on the news. It will continue to erode in terms of its technicals. Now the tariffs, the thing to keep in mind about the tariffs were originally, they came into being because to protect the economies of small countries. So in the case, let's take Sweden, for example. Sweden is a small country, and unless they have tariffs on their manufacturers, like the Volvo, they manufacture the Volvo in Sweden. If Volvo can't manufacture enough cars, it's not a big enough country to supply cars around the world. But if they let the Japanese into Sweden without putting the tariff on the automobiles, they'll put Volvo out of business because their costs are so much lower. So with tariffs, that's why the tariffs came into being, and that's why tariffs are good for some countries. So in terms of this really upsets the world's apple cart when you go in and the U.S. basically says, hey, we're going to put tariffs on every country until you eliminate our tariffs. He's going to win the battle, but the U.S. is going to lose the war, is what's going to happen. And that's why, bad things are going to happen with these tariffs as they stay in place. And I believe they will stay in place because the midterm elections are coming. They've got to stay in place until at least then, so that, because, the president was at a rally last night in Montana talking about this. He wants to reduce the trade deficit by $500 billion. That's what he's doing with it. But yes, the tariffs are going to really cause a much lower market by the end of the year.
Okay, all right, so I get it. Sell resistance and buy support. In other words,
right.
That's where we're going to go. Sell the rallies when they get to critical resistance areas, which is pretty easy to do. The only side of it is knowing that it's a trader's market, no longer an investor's market. And what statistics do you have to prove that the long-term investors have already left the market? Can you run that by me one more time?
Well, they measure turnover. I'll send you a chart. I'll send you a copy of the report so it can be posted on the site.
Right.
Okay, your site. But you can measure the total. It's the total volume of all the members of the S&P 500.
Yeah.
Okay, has turned over $2.9 trillion in the most recent quarter ending June 30th. And the last time that's happened was in 2008 that the number was that high, $2.9 trillion. And that's, so what happens is when all the long-term investors get out, now the market is really quicksand. It's basically short-term traders and a short-term trader who gets in to take a short-term profit. They're going to have to sell to another short-term trader, and that's why the market cratered like it did in the second half of 2008.
So is all the money going to private equity now?
No, the money's going into bonds. Some of it's going into private equity, some of it's going into bonds, and it's really going into bonds. If you look at the long-term bonds, the 30 years below 3%. The 10-year and the 30-year are about the 20 basis points apart, not even 20, probably 15 basis points apart on the interest yield for the 30 and the 10-year. So money's pouring into long-term U.S. government bonds, and that's these investors who are selling, and they're in for they're buying long-term bonds. When investors are paying, for 30 years, when they're buying a 30-year bond, it only pays 15 basis points, or one and 1/2% higher, okay, than the 10-year bond. That's a big signal that there's fear out there.
Well, we've got an inverse head and shoulders on the bond market right now. I'm looking at the 30-year right now as we do. All right, Mike, let's wrap this up for now. When we get more breaking news, we'll bring you back on, or you'll tell us when you need to come back on, and we'll post it for you.
Okay.
All right.
Thanks.
Thanks for watching CEO Money and Michael Yorba. Don't forget, follow us on Facebook and subscribe to our YouTube channel. Thanks.